Good evening, everybody. Welcome to our webinar on the two-component or the two-pot system. It's been called the two-pot system all along until suddenly in August the government sets out some amendment bill and calls it the two-component system, but it's the same thing. And so what we're going to do today is unpack that system and try and make it as simple as possible, but try and cover what we believe are the main issues and items with the new system. And we'll have two speakers. We'll have Suzan Ramotshabi, who I think you know, who's the person you talk to when you get on the phone to us at ETFSA. And she's a trustee of the fund. And myself, I'm the principal officer of the fund, so effectively the CEO of the ETFSA Retirement Annuity Fund. So let's move on. What is the two-pot system? Well, it's this amendment bill, which has gone through a number of drafts, and we now have a final bill, which has been passed by Parliament and signed by the President. And effectively what the amendment bill does, it enforces two things. One is that you have immediate access to a portion of your retirement funds. Now, up until now, you would have to retire over the age of 55 to be able to access your retirement funds, or else you've had the option, if you move your job and you have an employer-based retirement fund, you can take the full amount as cash, but then you're preserving nothing. So what they're now saying is you have immediate access to a portion of your retirement funds, but everything else has to be preserved. So those two things, access and preservation, is what the new Act does, and it does that even before you retire. And that's quite a big change in the way our retirement system is structured. It applies to all retirement funds. It's scheduled to take effect on the 1st of September 2024, so it's just down the road. And it has three components. So let's try and explain why it's called the two-pot system with three components, but we'll try and take you through that. There's a vested component. Vested component just means all your retirement funds that you've accumulated up until now, before 1st of September 2024, are vested. In other words, they are set, and the conditions and rules that apply to those retirement funds up until 1st of September 2024 will continue. And we'll take you through that. Then you've got a savings component, where from now onwards, all allocations of contributions that you make to your retirement fund, whether it's a debit order or a lump sum that you do once a year for tax purposes, that savings component is accessible. In other words, you can access the money that's in the savings component. Everything else goes to retirement component, and that retirement component is now fixed. It's preserved until you reach the age of retirement, and that's 55 years or older. So you've now got those three specific components, and I think that's really what we want to take you through during the course of this presentation. Perhaps we can just do a visual, a two-pot illustration. So you've got three pots. The one is the vested pot. In other words, that confirms and consolidates all your contributions you've made up until the 31st of August 2024. And that's your vested component. Then you've got any contributions you're going to make subsequently to this. 1/3 will be allocated to your savings component or your savings pot. That's the access pot. And the other 2/3 of your contributions will go to your retirement pot, and that will only be accessible when you reach retirement, which can be 55 years of age or could be older than that. There's another twist in this, because there's something called seed capital, and what the regulators said now, that of your vested pot, a certain amount, a maximum of 30,000 Rand or 10% of the value of that pot, but up to a maximum of 30,000 Rand, will be automatically transferred to your savings pot on the 1st of September 2024. So your savings pot kicks off with that 10% or 30,000 Rand. So that's a simplistic and a fairly simple picture of what faces us going forward. So let's take you through each of those in turn. And let's start with a vested pot. And you're tired of me chatting now, so it's over to Suzan, who can talk about the vested component.
Evening, everyone. Thank you for joining us this evening. So I'll first start with part one, which would sort of break it down nicely for you. So the vested component is what you would have accumulated from whenever you join the fund till the end of August. So this pot is what we call the vested component, meaning that it will give you vested rights. What does vested rights mean? It means that this component will apply with the old rules that exist within the retirement industry. So one would question, what is that? What are the old rules? Maybe I'm not even aware of that. So what are the old rules? So when you're in a retirement fund and your investment value is below 247, you are able to access the whole amount as a cash lump sum before retirement. So when you reach retirement and you have a value of 230, you're able to take it as a lump sum cash. But if you're at retirement and your investment value is above 247,500, this means that you have to retire and take 1/3 cash, and the rest has to go to a living or a life annuity product that guarantees you a pension. All this nice and hunky-dory. What happens to somebody who today is 55 years old? They can opt in or out of the two-pot system structure, because ideally, think about it. If you're 55 today, you can actually decide to retire. So the two-pot system doesn't really play much of a role for you. And then one thing that is important to highlight about the vested component is that it plays a vital importance in the seeding of the capital. So as Mike has mentioned, that you're going to have a savings component, and the savings component has to have a balance to start off. How do we get that? This is where you're going to seed the capital from. So what does this mean? Whatever you have in your vested component on the 31st of August, on the 31st of August, will be calculated 10% to a maximum of 30,000. I will try and help you understand this with the few examples below. So if today or on the 31st of August, you have a balance of 10,000 in your vested component, remember, vested component could be your pension, your provident fund, your retirement fund. It could be all, this is all retirement funds, as Mike has mentioned. So this 10,000 will be calculated by multiplying it by 10%, which means that you will then get 1,000 seeded into your savings component. But we all know that you will not be able to access this 1,000 because it will be below the allowable 2,000 that's accessible in the savings component. Then now we go into somebody who has slightly more or has been slightly stricter than the 10,000 client. So this one has about 120,000 in their vested component. If we multiply that by 10%, they're going to have 12,000 in their savings component, which means that they will be able to access this. And then we look at somebody who's not gone out to restaurants like all of us, has decided to save everything that they had and has 950 in their their vested component. So for them, this is where the trick comes in. 10% of this person's balance is 95,000, which means this is where the maximum takes effect. So only 30,000 will be seeded into their savings component. I hope this clarifies it, but if it doesn't, there's an example at the end that will help you understand how all of it comes together. So when you do get to consider accessing this seeded capital into your savings component, there are important things that you need to consider. And amongst those is the tax. So I know a lot of people or a lot of clients have already contacted us that I want to send me the forms, I'm ready to withdraw, but they haven't actually taken the implications that will take effect in accessing this. And one of the most important ones is the tax. And then the second part of that is the processing charge. We or the administrators are going to charge a processing charge of 200 per withdrawal. And then another part that we need to consider is if you have outstanding tax with SARS, this will be deducted before any payment is made to you. So ideally, what I would always advise clients is try to keep your seed capital in your savings component, because I mean, this is what you're going to have at retirement to actually access as a cash lump sum. So another example on your right hand side, you'll see is how this tax calculation or the tax implications that we mentioned in the important points to remember. So we have a scenario that we've put together where we have an individual who has 800,000 salary per annum and is currently in a tax bracket of 39%. They then, let's maybe assume that they have 30,000 in their savings component on the 1st of September and they owing SARS 5,500. What happens here? They then maybe decide to send us all the completed applications on the 15th of December. We then confirm that everything is in order and we start the process. What happens? We then apply for a tax directive with SARS. SARS comes back and says this person is in a 39% tax bracket, which means 11,700 will need to be deducted before anything is done. That leaves you with only 18,300 of your 30,000. So almost a third of this is gone. So it's important to see the effect of tax on this 30,000. From there, we did confirm that this individual owes SARS 5,500. So SARS will obviously go for that and deduct that from your withdrawal amount, which then leaves you with about 12,800. Not forgetting that administration is a cost. So we then have to deduct that 200 from the 12,800. And of the 30,000 that you initially started with, you only have about 12,600 left. So as much as it's attractive to want to access, and everybody's talking about the 30,000, in reality, you only have 12,600. Over someone who doesn't owe SARS, you have about 18,000 available to you. So we'll go and pass on the mic to help take us through the savings component.
Right, so we've got the savings, the vested component, which is what you've accumulated up until now. And we now have this new savings component. So from the 1st of September, 1/3 of all your contributions will be received in this component. That's the savings component. Plus you'll also have your seed capital, which is your 30,000 Rand or 10% of your existing from your vested pot. If you have more than one retirement product, let's say you have a number of RAs, you can take 10% or 130,000 Rand from each of those RAs, and then you will have a series of different savings components. So the savings component may be more than 30,000 Rand, the seed capital, but it all depends on where you are in terms of your vested products. Once you've done that, and you're now making contributions going forward, and you're contributing 6,000 Rand a month, well, of that 6,000 Rand, 1/3, 2,000 Rand will go to your savings component, and the other 2/3 will go to your retirement component. So now you're making contributions to two separate pots. The savings component is effectively the pot that you can access. The retirement component is the pot that you're going to have to preserve until you get to retirement. I'm trying to get this thing to move on a bit. We're having a slight technical problem here. Let's perhaps go back one, and then let's try and go forward one. So your seed capital, maximum 30,000 Rand, unless you have more than one product, plus your new contributions make up your savings pot. And so that savings pot can work up to quite a big amount of money over time. So let's look at how you withdraw money from that savings component. Now, how do you do withdrawals? As Suzan has said, well, you can withdraw from the savings component at any time, but you're limited to one withdrawal per tax year. So this is not an ATM. You can't take money out every month to go and spend a bit of your retirement cash in the pub or something like that. You can do it once a year and you can have a big pub night, but you're only allowed to withdraw from your savings component once per tax year. The second thing that you have is that your withdrawals, if they're less than 2,000 Rand, in other words, if your seed capital has built up to an amount that's less than 2,000 Rand, you can't withdraw it. So you can't take minor or minimal amounts out of your savings component. So your savings component it's there to start building up some capital for you that you can access over a period of time. So let's go to the next slide. And the other factor, and I think Suzan, covered this earlier. Now we're going too fast. Okay. Any withdrawals before retirement from your savings pot are taxed at your normal tax rate. They call that your marginal tax rate. And as Suzan said, before your administrator will pay you out, he has to go to SARS and has to get a directive from SARS. So SARS will say, this is the amount we're going to tax you, and you're going to be taxed at your average or your marginal tax rate. And that could be quite high. typically you go to about a 30% tax rate from very small amounts of income. So that's taxation that can be taken away from your savings pool before they pay you out. Could be quite substantial. And then there might be balances still owed to SARS for IT88s and so on. At retirement, you can now access the full amount in your savings pot. So let's say you've been building your savings pot over a period of time. You can now draw that as a lump sum. And that then gets taxed at the post-retirement tax rate, which is quite much better rate of tax than your normal marginal tax rate. For instance, the first 550,000 rand is not taxed at all if you withdraw money from your lump sum at retirement. So building up capital in your savings pot is often worthwhile rather than accessing it all the time or once a year for small amounts. So we've got an example here. Suzan always calls them ladies. So here we've got Sharon, but she retires and she's got the following balances. She's got 450,000 rand in her savings component. She can now draw 550,000 rand of that tax-free at retirement. And if she has more than 550,000 rand, then she's taxed at a much lower rate than a marginal tax rate. In fact, the tax rate only rises to 36% once you're over 1.1 million rand. Your retirement component, which is 980,000 rand in this particular example, will have to buy her a living annuity. In other words, a pension or a life annuity. But we've ETFSA RA fund, we provide living annuities to clients. So at 56 years, she has a lot more flexibility in terms of taxation. But if you need to withdraw from your savings component before that for emergencies, and I'll come to that in the next slide, then you can access it. So your savings pot is fully accessible at any stage, but once a year. Remember that. Now you can also transfer your savings component to your retirement component, your retirement pot, but you can only do that once a year. Once you've done that, that money that sits in your retirement pot has to stay there till retirement. So you've now lost access to this money. So it's often worthwhile keeping money, building up your money in your savings component. So now we're going too fast. Right, so should you access your savings pot? So there's a graphic there. Let's say you've got your 30,000 rand from your seed capital, and that's growing at 8% per annum. Now, if you're 45 years old and you've got 10 years to retirement, that 30,000 rand would grow to about 150,000 rand. If you are 35-year-old with 20 years to retirement, well, then it'll grow a lot more. And if you've got 30 years, 25 to 55 to retirement, your 30,000 rand will then have grown to close to 700,000 rand. So the effect of compounding by just keeping your seed capital going is well worthwhile considering. So look at your savings components and say, well, I might need to draw on this, but I should only do this in emergencies. We all have emergencies. But don't forget, once you've taken that money out of your savings pot, you tax at the full rate and you can't put it back again. So you've now lost the impact of that capital growing towards funding your retirement. So try and aim, if you can, and we have costs and things like that you need to meet, try and take your near-term liabilities and costs with your near-term earnings or cash flows, and don't fund it with your retirement assets. Those retirement assets can be there to perhaps help you pay off significant amounts, your bonds and things like that when you get close to retirement. So your savings pot is now accessible. Just remember, it's only a third of your contributions, and it's only been seeded with that 30,000 rand per product, per policy. Let's now move on to the retirement product, and we'll pass back to Suzan.
Thank you. So with the retirement, the third part being the retirement component, this is ideally your long-term plan. So this is where the retirement structure of the two-pot system forces you to preserve. So like Mike mentioned in the initial slide, where the main thing of the retirement component is that it will receive 2/3 of your contributions. And then in this instance of somebody who has a contribution of 6,000, 2,000 will go to the savings component being the 1/3, and then the 2/3 being the 4,000 will go into the retirement component. It is important to realize that this component is not accessible. So you can have an emergency, you can have whatever situation you fall in. This is till you reach 55 years or older. And then this money, you cannot access cash. So in this component, all the money that's sitting in this component can only buy you a living or a life annuity upon retirement. And at that point, it guarantees you a pension, which will obviously help sustain you. Then we're going to go on to why do we need, obviously, let me put it this way. Do you need to change your investment decisions when it comes to the two-pot system, or do you leave things as they are? This graph or this illustration is going to help you understand how you should view your investments or the two other pots going forward. So if you plan to actually access your savings component, you can see from the portfolios, or maybe let me first start for all the new investors or potential investors. On the ETFSA RA product, we have 5 investment portfolios that range from low risk to high risk. And you'll see that the first 2 are low risk, but the other one is a money market account, our money market investment, and then the other 3 range from medium risk to high risk. And as you could, the illustration clearly determines that the lower risk it is, the more the defensive assets, and the higher the risk is, the higher the growth assets. So how do you structure your pots in consideration to this? If you're planning to access your savings component, because obviously when the 1st of September hits, all our clients are going to have 3 components of their investments. And if your current investment portfolios are, let's say, for example, default, you are going to be in the default. But if your intention is that you're going to access your portfolio or your savings component, it would be ideal to be in a protector or conservator, because your intention is to access it and be in a more lower risk portfolio. And if you are an investor who actually has no intention to access your funds, although they're going to be in different pots, you can be in a default portfolio, for example, or the wealth enhancer being a high risk portfolio. Because the main point of this is because you can't be in a volatile portfolio while you actually planning to access the funds, because you might end up being in a hectic part of the market, and then you access the money and you've lost. So ideally, rather be in a low risk portfolio if you know you're going to access it, and then for the other vested component or your retirement component, which has a much longer long-term expectation, you can be in like a medium risk to a high risk portfolio. So this kind of helps you understand that all the 3 components will have different investment objectives, which means they'll fall under different investment portfolios. If you do end up wanting advice or guidance around this, we can also take you through it. Then we're going to go to this illustration, which will help clarify the 3rd slide that we discussed. So this is like a full-on 2-pot system structure of somebody who's at this age. Well, so for in this example, you see Gareth is 42, and Gareth has a marginal tax rate of 39%. Gareth has a pension fund of 700,000. He's contributing 12,000 a month. So you see Gareth's vested component has 700,000 as an closing balance, because on the 31st of August, this is the balance that will sit in this vested component. And because, as Mike discussed, there's going to be a portion that's going to be seeded to the savings component. So after seeding, Gareth will have 670 in his vested component, because the 30,000 would have been seeded in the savings component. From here, then Gareth then makes contributions on the 25th of September maybe, and that 12,000 will be split according to the 2/3, 1/3 distribution. So 1/3 will go into the savings component. So Gareth at the end of September will actually have 34,000 in the savings component to access. And in the retirement component, then Gareth will start accumulating 2/3 of all contributions that he then makes. Then from this example, it's important to realize the implications of all this, or when you do get to a point of reviewing the whole structure. So from a vested component, when Gareth does get to a point of retirement, Gareth will have the choice of either transferring the whole amount to a living or a life annuity product, or when Gareth decides to say, I want a cash portion, what will happen is that Gareth will only have access to 223,000 plus return in the vested component, and then the rest has to buy Gareth a life or a living annuity product. And I just want to give you guys just a reminder of the vested rights that I mentioned earlier. So as you could see here, this distribution of how this is split is according to the vested rights. So Gareth needs to take 1/3 and the rest has to go to a living or a life annuity product. So Gareth can't take the whole amount in the vested component as cash. And then the savings component, like Mike mentioned, it is immediately accessible, but subject to tax, but also importantly once a year. So you can't contact us 3 times and want a withdrawal from your savings component. But if you have different products with different financial providers, you can access all of them, obviously contacting individually, and access your savings component. Then the retirement component, you have to buy a life or a living annuity product with the money that's in here. You are unable to access any cash from the retirement component. Then from here, you'll see we will go into the changes, also highlighting step by step what changes fully overall in the retirement industry when it comes to the two-pot system. Because obviously when we do discuss the two-pot system, there are some things that are not part of the two-pot system but have a few changes. So with the contributions, as we mentioned, now contributions going forward will be split according to a 1/3, 2/3 split, where your 1/3 will go to your savings component and then the 2/3 will go to the retirement component. And then with excess contributions, anything that you owe excess contribute into your retirement, into your investment or your RA or pension, will have to be allocated to your retirement component. So this prevents you over contributing, thinking that it will go into your savings component. So whatever is in your savings component will be the only thing you have access to. So you can't cheat the system. Then we go to what doesn't change. You will still have your 27.5% contributions that will be taxable to a maximum of 350 per financial tax year. So that doesn't change. The retirement age doesn't change. So you'll need to be 55 years to retire, 55 years or older to retire in South Africa. And then we come to accessibility. So this obviously just highlights what we've already mentioned, that you can access your savings component, then the rest has to be preserved. But importantly, Mike will go through this part, but also we'll go through it at the resignation point, where we highlight that accessibility, you're going to have access to your savings component, but it's going to be different for people who have a vested component. We'll go through this later. Then we get what doesn't change. So your vested components gives you access to cash before retirement. But remember, it's going to be taxed according to the pre-retirement tax table, which is relatively higher compared to waiting till you retire. Then transfers. Transfers will still be permitted. So you can still do Section 14 transfers or transfers from your employer to consolidate into your RA. That will still happen. But what will change is that it will be processed per component. So it will be from your old vested component to your new vested component, from your old savings to your new savings, and your old retirement component to your new retirement component. And as I mentioned, nothing changes. So you can still continue doing transfers tax-free. Then we come to the resignation part. So if right now you decide to resign after the 31st of August, you're going to have 3 components, or what we call 3 pots. You're going to have your vested component, your retirement component, and your savings component. So when you resign, you have access to your vested component. Almost had to check myself. You have access to your vested component because, as I mentioned, that is your vested, that remains within its vested rights. So this will allow you to do what you could do before. So you can access this when you resign and say, I want to withdraw this and take cash, or I want to move it to my consolidated to my RA. You are able to do that because it remains within its rights. And then after that, all contributions going forward from there will be split into your retirement and your savings pots. What doesn't change? When you leave your employer, you can still consolidate your RA. That doesn't prevent you, like I mentioned earlier with transfers. You can still do what you could do before. Even your preservation funds, you can still consolidate them or move your pension to your preservation fund. I'll give Mike to finish off.
Right, so let's just wrap up 1 or 2 other things here. Just remember that you can pose questions to us on the system, and we'll answer those questions as best we can. We're still here for a while because we're making quite good progress, and this is the last formal slide we want to show you. And I think we just try and cover some of the other issues that are involved. So now divorce. The critical issue here is that each component will be proportionally allocated as per the divorce decree. So just remember that if you've got if you're going to get divorced, make sure that you're fully aware of how much of your policy that your husband has got or that you've got is a vested component, how much is a savings component, and how much is your retirement component, because we will allocate as per the divorce decree into each of those components. So the vested, you will have access in terms of your old rights. The savings you can have full access to, and the retirement pot will be preserved until retirement. So be very careful going forward that your divorce lawyer mentions each of these specific pots, because otherwise, if he doesn't mention it, then the savings the new contributions that are sitting in the two pots, the savings and the retirement pot, they might be left out of the settlement. There's also been some changes in terms of what qualifies as divorce. It's not when you lock the door and you kick the old bloke out of the house or vice versa. It's now as this thing progresses through the courts. So there has been some changes in that, and we're still waiting for final clarification on that. Same thing with your death benefits. Once the death claim process is finalized, the distribution will be executed per each component rather than just from one fund. So the savings component will be distributed as part of the savings component and the rules that apply there, and the retirement component in terms of those particular rules. There's no change in terms of retirement lump sums at 55 years or older. You're taxed according to the post-retirement tax tables, and you have that tax-free lump sum applicable at retirement. So the taxation hasn't changed, other than it's now allocated per different components. If you withdraw from the savings component prior to reaching retirement age, then you've got this marginal tax rate. In other words, your total tax rate applies. And so it's not all that attractive sometimes to take withdrawals out of your savings component because of the taxation issues. In terms of the investment portfolios, we currently offer, as Susan explained, 5 different investment portfolios, and you can invest any of your components, the vested, the retirement, or the savings component across any one portfolio, or a mixture of all those 5 portfolios that we offer. All the portfolios are Regulation 28 compliant at all times, and so that's worthwhile looking at. What is your risk profile, and what is your horizon until you reach retirement as to where you go, which investment portfolio you choose, and we can help you. We can give you some advice on this. Any withdrawals from the savings component will incur an administration charge. There's quite a lot of work to be done here, because if you withdraw from your savings component, we have to go to SARS and get a directive. We then have to apply that directive, and we then have to process the payment out from the savings component, so it has to be paid into your bank account, and that creates a lot of additional work. So there will be a maximum administration charge of 200 Rand per withdrawal, but if it's a fairly small withdrawal, then it's a percentage of that. It won't be as much as 200 Rand. That's the bad news. The good news is that the composite fee that we charge in the ETFSA RA fund of 1% per annum will not change, and will be charged over the whole policy and not per component, because if we charge 1% per component, we could compound the fees up a bit. Now that's quite a useful concession that we're making in the ETFSA RA fund, because we're seeing a lot of other retirement funds are saying, hell, this new system is much more complicated, so our fees are going up. So just make sure that with the new components that you're not paying additional fees. And the retirement funds are quite justified in doing that, because there's a lot more work involved to now run 3 separate accounts, 3 separate policies for each member. But we will be charging the same fees. Fees won't change, but there is a withdrawal fee of 200 Rand. Returns are in the different portfolios, will allocate those returns to each particular component. So that hasn't changed. And then immigration, they have said, and it's something that's just popped out very recently in the tax amendments, that your vested pot and your savings pots can be fully withdrawn if you formally immigrate. So formal immigration means you have to go through a process of moving out of South Africa, becoming a taxpayer in another jurisdiction, becoming a citizen in another jurisdiction, but you will have access to your vested and savings pots. But your retirement annuity capital can only be withdrawn 3 years after formal immigration. So there are some concessions there, and also come and talk to us if you're thinking of immigrating. This morning I did some recommendations to two chaps who do in that particular area. They're immigrating, and what do you do? So it does need to be considered how you handle that immigration. And so I think that covers what we think probably are where there's changes and where there's no changes. The one thing I think we need to consider is that the vested component, be very careful about moving that vested component to the two pots component as a whole. And you can also decide to opt out of the two-pot system. If you're over 55 years of age, you're in the vested component already, you can say, I want to stay in that vested component. Yeah. And if I make new contributions, let's say at the end of the tax year, I'm going to pay some extra money into my retirement annuity to get tax deductions, I can do that in the vested pot. Yeah. I don't have to move to the two-pot system. But if I'm making contributions on a consistent basis, then the two-pot system can be quite valuable, because now you're building up capital in your savings components, and you can access that savings component at any stage. Or when you reach final retirement, the only money you can then withdraw is what's money sitting in your retirement component. Sorry, your savings component. Whereas in your vested component, you can take 1/3 as cash and 2/3 as annuity. In the new system, what's in the savings component, you can take that on retirement or before retirement. Everything else has to go into preservation. So hopefully that's uncovered, as we say, trying to unlock the new system. It's not all that complex. I think it's an improvement on the old system because it's become more flexible. And I think it's something that we shouldn't be afraid of. It's something that we should embrace. But if you're not clear on anything, come and talk to us, and we will help you as best we can. And there may be some questions even now that we can answer. Is there anything, Jenny, that you'd like us to cover?
Yes, Mike, we've got quite a few questions. And the first one is, I think, quite a few people saying that they're unable to make the presentation, and will there be a recording available afterwards? Yes, we will be sending out the recording tomorrow, so you don't need to worry about that. You can always catch up. Mike, I've got a question for you. What is the marginal tax rate on the savings withdrawal post-retirement?
Yeah, so post-retirement, what happens is that the savings component will then be taxed at the post-retirement tax table. So there's 3 tax tables. I hope we're not going to complicate things too much. There's your normal tax that you pay from your income. Then there's your pre-retirement tax table, where the first 27,500 is tax-free, and then the rest then gets taxed at different rates of tax. And you hit a 36% rate quite early on. Post-retirement, the first 550,000 Rand you withdraw from the savings component would not be taxed. And then you get taxed at a sliding scale up until 1.1 million Rand, at which stage the 36% tax rate applies. So there are some quite big benefits in keeping your savings component going until retirement or until 55. Hopefully that answers that question.
Thanks, Mike. Suzan, does it apply to RAs and pension funds, and also to everyone irrespective of age?
So I'll start with the first part. It applies to everyone. As Mike mentioned in the first slide, this will affect all retirement funds. So if you're in a pension, a provident fund, a retirement annuity fund, this affects you also. And then the second part, where age, as I mentioned, if you are over 55 years, you can opt in or opt out. So Once the 1st of September hits, you can email us and say, look, I don't want to be part of the two-pot system. And obviously, according to our records, we can verify that you're over 55 and you will stay as an only vested client where you won't have savings and the retirement component. I hope that clarifies it.
Next question from Mr. van der Merwe. Can I opt out of the savings pot and only have a retirement pot?
Yes, you can. So it can either work either way, Mr. van der Merwe. So you can either be part of the two-pot system and then decide to move your savings component to your retirement component. But an important part to remember about that is that once you move funds from your savings component to your retirement component, you will not have a cash portion. So this then restricts you from saying, I want to use my 550 at retirement. You will not have money to use your 550. You'll only have money to buy a living or a life product, which will guarantee you a pension.
Okay, another thing I think, and perhaps we can just clarify this between Suzan and myself, is you have to be over 55 to say I'm going to opt out of the vested component. In other words, if you're under 55,
no, you can't.
You
automatically
your new contributions will go to your savings pot and to your retirement pot.
Yes.
If you're over 55, you get that
opt-in,
because you've now retired.
Yes.
So you can say, well, I want to act as a retired person.
Yes.
I'm 55 years in one day, and I just run the Comrades Marathon in 3.5 hours. So I'm not really a 55-year-old, but in terms of the law, you're regarded as being past retirement age. So there is some flexibility, but perhaps we'll need to just consider your particular example, Mr. van der Merwe, specifically.
Okay. Mike, I've got another question for you. I'm already over 55, but as I still work I've kept my RAs. Is there any benefit to retire from these before 1 September?
I don't think there's a great deal of benefit from doing it, because as long as you're still working, you don't need to draw income. The minute you retire and you get a living annuity, you have to draw an income from your living annuity in terms of the regulations. Yeah. I would say keep on making the contributions. If you've got the two-pot system, that's fine. You can always convert your savings component to your retirement component and build up additional money. Now you've got your vested components and you've got your post-vested, post-September money. You can combine all that into a much bigger living annuity, which you can then enjoy your bigger income going forward. So don't opt out of it because it just seems a bit complex. It's, I would say, stay in it. But if you are over the age of 55, you can opt out.
Yeah,
as Suzan said,
that's correct. And just to add to that, also we can help you. So if your concern is that you have different RAs, we can help you consolidate that and have one set of vested savings and retirement components. So if you want to simplify your life, you can contact us and we'll do an analysis for you and see if the better option is to consolidate all that.
I've got a question in terms of process. How long after I apply for withdrawal can I expect to receive my money?
We're going to meet with the administrator this week, but we've been looking at this for a long time. And he says, well, all things being equal, if I can get a director from SARS, there's going to be a queue for SARS for the next, who knows how long that queue is going to be. The minute we get a director from SARS, we'll pay you out. Yeah. So it could be very quickly, but it's really dependent on so there is a process. I mean, you mentioned the word process. There's a process, but we're not going to say like some, I don't want to be nasty about any people, we're not going to be able to pay you anything out for a couple of months. If we can get the process through SARS, we'll pay you out within probably 7 days or so.
Yeah, a few days, yeah.
So, but we can't
pay you without applying for a tax directive.
And we can't guarantee you a payment day. So we don't want to make promises, but it won't tie you down too much.
Yeah.
We've insisted that this thing has to be flexible. Somebody wants to take the money out, well, let's pay the money out and move on from that point of view. Let's try and lock that money in indefinitely. You want to add anything to that?
No, I'm happy with that. Thanks.
And I think this question will also apply to meeting with the administrator next week. Will the statement show all three components balances?
Yes. So that will, so from the 1st of September, logging in, which obviously we will keep, as we promised, we will keep communicating with you guys as to where we are with progress. So if there is any sort of delays when it comes to the system or processing, it will be communicated to all clients. But as we plan to get the system into place, we see a smooth sailing. unless anything happens from SARS perspective. But what we plan to take effect on the 1st of September is that you log in and you see 3 components. So you'll have the same policy number, but you'll have 3 different components under your policy number.
If I'm already older than 55, will contributions still be split into the relevant pots?
This will be dependent whether you do opt in or opt out. So if you opt in, yes, they will be split into the savings component and the retirement component. I don't know if that answers it. So it's more dependent on whether you take the option of being included or excluded from the 2-pot system.
And I think we've covered the process. What's the process of claiming savings to my bank account? Obviously, once we get the withdrawal forms, it's applying for the tax directive. That's the main thing, and then we can proceed with
I'd
payment.
ask you for details of your bank account. If we have a bank statement that's fairly old, because we have to check.
Yeah,
It's part of the whole process of money laundering, all the rest, to check that we're paying the money out to the right member of the retirement fund and it's to the right bank account.
Yes.
So there's a checking process there, but while the administrator is waiting for the SARS to come back, they can undertake that. So I think the process will be fairly smooth.
Mm-hmm.
And don't forget, we do we pay money out of when people withdraw from retirement funds.
Mm-hmm.
We're used to doing that, or transferring retirement funds. So that whole process is quite well lubricated. There will be a communication. Probably we can check on that when we meet with the administrator again next week. But that we will probably communicate with each member what the seed capital will be for them,
Mm-hmm.
and tell them what their rights are, whether they want to vest in or vest out. Obviously, it will depend on their age. So there will be communications with members, which you'll get probably before 1st of September.
Mm-hmm.
All right. Marilise is asking, I'm intending on moving my RA from Allan Gray to ETFSA. If I start the process now, funds will only be transferred completely in 4 to 6 weeks. Once the funds are transferred, will it stay in the vested component or will it be split between the 2-pot system?
Okay, so Marilise, the important part here to remember is that when the transfer is started before the 2-pot system takes effect, that those funds are actually vested. So whatever we transfer, so when Allan Gray contacts us, or when we contact Allan Gray and say you've decided to transfer, those funds are vested. So anything before the 31st of August is vested. So we will then transfer those funds from Allan Gray vested into your vested component.
Got a question about the IT88 issue that you've mentioned. How would I know if there's such an IT88 for me prior to withdrawing?
That is on you. So you need to make sure that your tax affairs with SARS are in order. So whether you go to your e-filing and check out how everything is doing there, that is certainly on you. And the important thing to highlight is that once they do deduct the IT88, it's irreversible. So before you actually send us your FICA and your completed application form, I think the vital step to take is SARS first, just to ensure that everything is in order there and you don't have any oopsies happening and the whole amount is taken by SARS.
Yes, we'd love to help you out with this particular issue, but we don't know in advance.
Yeah.
We can't access your tax account. So you have to have some knowledge of what happens. And if SARS starts the process and they say, right, we're going to withdraw tax in terms of the tax rate, but there's also an IT88 outstanding, they'll take that tax.
Yeah.
We can't stop it. So so somebody's going to make money out of this whole process will be SARS. But they tell us they need the money. But that is something, Susan's quite right, it's up to you to make sure your tax affairs are updated and all the rest. So very good time to withdraw from your savings pot is once you've got a letter from SARS saying your taxes, or what do they call it? You get that letter confirming that your tax affairs are in order and all the rest. Then there's nothing owing.
Yeah.
So sometimes that's worthwhile, just waiting to make sure that there isn't a sting in the tail in terms of taxation withdrawals.
All right. Is it better to pay this year's full RA amount before or after 1 September 2024?
I'll start, and I think Mark can add to that. When looking at it, I would think it's ideal to put it in the vested component before the system takes effect, and then knowing that from the 1st of September, whatever you make into the RA will be split. So ideally, if you are a person who sort of has a business and has sort of is a high income client, then you can actually do your 350 now, put it in your vested component, and then wait till next year where it will be automatically split. I don't know if you want to add anything to that.
No, that's the right answer. So if you've got the cash and you're working out your provisional tax payments right now before the end of August, then make a contribution to the RA fund, which will go in the vested component, because any contribution after 1st of September will have to split between the savings and the retirement component. That may be in your favour, because you want to perhaps withdraw from the savings component, but may not necessarily be in your favour. One thing, and I think Suzan did highlight it in that table of hers, the practice of saying, well, I'll make contributions of 350,000 Rand or even more, even if my taxable income isn't sufficient to cover that, because it'll be carried forward as a credit. In terms of the new system, if you make an excess contribution, they'll automatically put that in the retirement component, so it'll be preserved. So you won't have access to that money. But you'll carry a tax credit forward, but the money will be in the retirement component.
Yes, that's correct.
Okay. I've got a great question here about investment selection in the existing ETFSA RA portfolios. Will ETFSA automatically keep my current investment selection between the different RA portfolios, or do I need to specify what I want for each component?
So on the 1st of September, when the two-pot system takes effect, you will stay in whatever you currently invested in, unless you contact us and want to switch into specific portfolios. So it's going to be as per your discretion. Nobody's going to sort of pin you to a specific portfolio. So if you're currently in 2 different portfolios, that will be in each component.
George asks, is the transfer from the savings to the retirement pot going to be taxed?
No. You're just moving from one component to another. But once you've transferred to the retirement component, you can't transfer back. So it's a once-off transaction, but there's no tax implications. You're sitting within the tax environment of a retirement fund, and they won't tax you for transfer. It's like doing a Section 14 transfer. You're not taxed on transferring from one retirement fund to another. You're going from one component to another. That's not a tax event.
Okay. Loretta asks, will the withdrawal also be taxed at one's marginal tax rate? That is correct. Loretta, you will be. We've got a good question from Miss Wilson. I'm over 55, so can I choose to opt in or opt out? What is the default? In other words, what happens if I do nothing?
So on the 1st of September, everybody will be on the two-pot system. Unless you're 55 and you contact us and say, I don't want to be, then that's when we'll only then reverse you. So automatically the default is everybody will be on the two-pot system unless we contacted otherwise.
So that's why I said, was it Loretta who asked the question?
Yes.
We'll try and probably contact you before 1st of September to say, if you want to opt out, let us know. Because otherwise, automatically,
you sitting two-pot.
We'll sit with this with a 3-pot system, and we'll have seeded your savings component with your seed capital already. So that's the only way administratively the thing can work to be. But you can let us know in advance, and we can make sure that you don't become part of the 2-pot system if that's not what you want to do. If you're over retirement age, everybody's slightly different, but I would say if you're over retirement age, stay in the vested pot.
Because anyway, I mean, you're over 55. Why would you want to be taxed more when the advantage is to be taxed less? Because you're 55. So you have to use your advantage. So ideally, if I was 55, not that I want to be 55, but I would certainly want to stay vested.
I'm currently a member of GPF. Will the 2-pot system also apply to my GPF pension fund?
To you, and probably it's already communicated, but as I mentioned earlier, the 2-pot system applies through, it's a blanket effect. It will apply to all retirement funds in South Africa.
That's very important. That's people are being told, it doesn't apply to us because we're GPF or we're the Transnet pension fund. It applies to every single retirement fund in South Africa. The two-pot system will be applicable
Overall.
going forward. So, so don't believe it if people tell it. It's not me. It's it's going to apply to you if you're in any pension fund in South Africa. It includes your pension funds, your provident funds, your preservation funds, your retirement annuities, your umbrella funds. Everything comes in under this all-embracing legislation.
The remainder of the questions are quite specific to clients, so I think we should get back to those tomorrow.
Tomorrow. And in the meantime, thank you very much, everybody, for listening in. It's always a pleasure to talk to you. Because of the constraints of time, normally we'd have a live seminar, but, there's so many things going on at the moment that we couldn't do that. We will be doing client seminars during September and October. We'll be down in Cape Town on the 16th of September, and we'll be in Joburg, I think, 3rd of October, and we'll be in Durban on the 10th of October. Is that correct, Jenny? So we will be seeing you hopefully in those venues, and we can then carry on talking about the two-pot system and some other exciting things we're doing in the ETFSA at that point in time. So hopefully we can see you then if you do want to consult us. But otherwise, just get hold of it. That's what Suzan does. She's there to service clients. And when she's really busy, she passes it on to me, and that's the second best option. But we all try as hard as we can to. We're a small fund, and we're known for our client service. And this two-pot system, I think, works in favour of smaller, more flexible retirement funds that can give that client service. It's going to be a nightmare for the bigger companies with thousands and thousands and millions of clients to be able to give that sort of service. We'll do our best to give the best service we can. So thanks very much, everybody, for joining us. And thanks to CorpCam for facilitating this session. Thanks particularly to Suzan and Jenny for doing the questions. And we'll see you all again soon, very, very soon, I hope. Good night.